Hello everyone, warm welcome to Testbook Super Coaching. My name is Madhav Sir. I welcome you all in the next session of the series, that is Basics of Finance. As you all know that whether you're preparing for RBI, NABARD, SEBI, ECGC, SIDBI, whatever examination, this finance topic is really very important. Now, the moment we start the discussion, or before I should start with the discussion, I have a very simple question for everyone. And my question for you all is, whenever we say that finance is important, along with this statement, there is one more important part which you must understand, that finance is important not because of its weightage, it is also important because of its importance as well as the concepts which are need to be clear. Until and unless concepts are clear, you won't be able to understand the related economics, related financial terms or related financial news, and news or current affairs are important. So keeping that in mind, let's begin the discussion where we are going to cover one of the new topic in the same series, that is Basics of Finance. If you remember, in the yesterday's session at same time, that is at 8 p.m, I was live with you where I have discussed a very important topic. If you remember, I don't know whether you have watched that video or not. I have discussed functions of commercial banks, in which I have discussed a very important area of the functions of commercial bank, that was credit creation. And even in that session, I have discussed with you that bank is responsible or bank is involved in n number of operations, but along with these n number of operations, bank, or I would say the basic function of the bank, is to accept deposit as well as provide loan. Now, one thing is clear, that if we are talking about a bank and a bank is accepting deposits, against these deposits, bank will provide the same amount on loan. Now, bank will be responsible to pay rate of interest against deposit, because let's say there is an individual who wants to deposit his funds with the bank. Obviously, he will be looking for return, and that return is termed as rate of interest. Now, on the other side, if bank is providing you loan, that means bank is giving his own funds to you and you can use those funds. Obviously, bank will charge certain amount of fees on it. It's very simple. If you use an asset, for example, if you are hiring a taxi, then also you are using that taxi, you're using the asset, and you will pay rent or the tariff the moment you will be stepping down. Same goes for a flat which you use for your temporary residence. You pay rent on regular basis. In a similar manner, if you're using bank's funds, you will be responsible to pay a return, and that return is termed as what? So that return is termed as lending rate. That return is termed as lending rate. And obviously, if I am a bank, then I will be trying my level best that the gap between lending rate and rate of interest should be maximum, so that my profit would be maximum. For example, bank, as we discussed in the yesterday's masterclass, where I told you that bank can accept deposits in the form of demand deposit, term deposit. Then we have two types of saving account and current account in demand deposit, two types of account in term deposit as FD and RD. So let's say the average rate of interest, is 5%, which bank is paying on the deposit, and the average lending rate is, let's say, 12%. So the gap between the two is going to be bank's profit. What is this termed as? Sir, this gap is termed as NIM. NIM stands for what? Sir, it stands for net interest margin. It stands for what? It stands for net interest margin. So as per my example, the net interest margin is going to be what? So net interest margin is going to be average lending rate. Why I'm using the word average lending rate? Because the lending rate is not same for every loan. Similarly, the deposit rate is not same for every loan, or for every deposit. So we calculate the average value. Practically, the word average is also wrong. We must use a word weighted lending rate. We must use a word weighted rate of interest, and the gap between the two is termed as NIM, that is net interest margin. Got it, guys? Clear? Now, if I say bank is paying 1 lakh rupees as rate of interest, now I'm discussing the same in a, I would say, I'm discussing the same in the absolute numbers. 1 lakh is the rate of interest and bank is receiving 2 lakh rupees as lending rate. So this is the amount bank has received. This is incoming amount. This is outgoing amount. And the difference between the two is known as NII, that is net interest income. So these are the two important terms related to what? So related to loan. The first term which is important, that is known as NIM, which stands for net interest margin, and the other term which is important is known as NII, that is net interest income. Net interest income is basically the absolute difference between the lending rate received and rate of interest paid, and NIM is basically the percentage. It is basically the difference between the lending rate and rate of interest, but in the percentage form. So this is the percentage amount and this is the net income amount. Got it, guys? So two terms are clear to you. One is net interest income and the other one is net interest margin. Now, let's move on to the next term. The next point says, sir, bank is responsible to provide loan and bank provides loan to the borrowers. Before I discuss that, I have an important information for you. If you are preparing for RBI Grade B 2025 examination, we have Lakshya batch live for you. Do join this particular batch, and if you are joining this batch in these days where we have an offer, that is September Scholar, use the code MADHAV and you will get this batch for just 10,800, and that too your subscription will be valid for not 12 months, rather 16 months. You can even connect with me on my Telegram channel. This is the QR code. You can scan and join with me on the Telegram as well. Now coming to the point. The point is, so bank is responsible to provide loan. But I have a question. My question is, have you ever given a thought that how bank decides this lending rate? Have you ever given a thought that how banks decide this lending rate? What will be your answer? See, the answer to this particular question is, I would say till 1991, I'm not sure that whether you are aware of this or not, till 1991, government and even RBI, they were very interfering in the bank's day-to-day operation. So we can say that till 1991, lending rates of the bank, that means if SBI is giving you the loan, if PNB is giving you the loan, if HDFC is giving you the loan, I'm talking about that lending rate. So lending rate was decided by authority or decided by the external factors where we have government involvement and RBI. Okay, now the picture changed in 1991. So I will be focusing on 1991 majorly. So the picture was changed in 1991 when there was a setting up of committee. I'm not sure whether you are aware of this. That is Narsimhan Committee. This committee was set up twice, first in 1991 and then later on again. The committee recommended liberalization of banking sector along with the liberalization of the economy. During that liberalization part, it was stated that now banks will be deciding. Now banks will be deciding their lending rate. So lending rate will be, or I would say was decided, I'll write straight away, lending rate decided by bank. Lending rate decided by individual bank. Lending rate decided by individual bank. It was a good move. Undoubtedly, it was a good move. Things were going very in a positive direction. Everything was fine. But in 1991, there was one more statement. The statement was that we should set up new private banks. And in 1991, many new private banks were set up. For example, we had ICICI, HDFC Bank, all these banks, they were set up. Now, if banks are deciding their lending rates independently, then obviously, the banks, the newly set banks like HDFC, ICICI, these banks, they have low operating cost because I've just set up a new bank. obviously my operating cost is less in comparison to the bank, which has already 10,000 plus branches all over the country. So this decision resulted in an unhealthy competition in the economy because a newly set up bank was charging low lending rate and it was acquiring the entire market. The moment RBI realized this situation, but bit late, in 2003. So in 2003, RBI came up with a statement. RBI said, from now onwards, lending rate will be decided by individual bank, Now you must be thinking that, sir, this is the same statement which you have earlier mentioned. What is new in this? The new is lending rate will be decided by the bank, by the individual bank on the basis of methods given by RBI. Are you getting my point? This means that now RBI will be giving you the methods. On the basis of those methods, you will be deciding the lending rates, but independently, and your lending rates can be different. That power has been given to the banks. So in 2003 till 2010, RBI came up with a method which was termed as BPLR, benchmark prime lending rate. BPLR, benchmark prime lending rate, which is clearly mentioned on your screen. In 2010, I'll discuss those reasons, don't worry. Then in 2010, it was replaced by base rate, and base rate was implemented till 2016. Then after base rate was replaced due to again some reasons. In 2016, a new rate was introduced that is known as marginal cost of fund based lending rates, that is MCLR. And since 2009, to be very precise, since 1st October 2009, we have a new rate that is EBLR, external benchmark lending rates. So these are the methods till date. Which have been implemented or which have been introduced by RBI in order to decide the lending rates. Is it clear till this point? Say yes or no. Okay. Now the point is, what was BPLR? So BPLR, as the name suggests, benchmark prime lending rate. So before we understand this rate, you must understand prime lending. Whenever bank provides a loan, bank classify its loan into two categories. One, it is termed as prime lending and the other one is termed as subprime lending. Prime lending means an individual or company or a firm with good credibility, as well as the company has given adequate amount of security. That type of loan is prime lending, where obviously bank takes the customer as a prime customer and bank is expecting the return in near future for sure. What does RBI say? RBI say that we will fix a lending rate, and that will be the lending rate which will be charged by every bank. On their prime lendings. For example, they have fixed a prime lending 7%. So every bank will charge same lending rate, that is 7%, if it is a prime loan. The moment customer will come, if the customer is prime, then it will be prime, means the customers has fulfilled the security norms. Customer has completed all the security requirements, all the KYC requirements, and customer credit rating is also good. That means customer has borrowed the loan in the past and paid back on time. So it's a reliable customer. It's a good customer. Bank should give loan to these kind of customers even at low rate of interest so that their funds are secured. But the moment new customer enters with low security norms or with low credibility, then banks, they can increase the lending rate as their risk increases. That was termed by RBI. But again, this was the time when there was very neck to neck competition going on between the banking sector. So what does the bank started doing? Tell me one thing, who will decide the loan is prime lending or subprime lending? So bank will decide. So if I have to decide the loan is prime or subprime, then what will I do in order to attract the customers, in order to increase my credit in the market, in order to capture the customers? Being a bank, I will be categorizing subprime lending into prime lending. And this was literally done, due to which loan was given at a low lending rate to the subprime customers, but considering them as a prime customer, due to which many loans they turned into NPA, and banking sector as a whole has witnessed great risk. After witnessing this situation, RBI overtook BPLR, and RBI has introduced a new method, and that method was termed as what? So that method was termed as base rate. Now what does the base rate means? So base rate is defined as what? Please pay attention. So base rate basically means the minimum lending rate below which bank can't lend. Bank can't lend. So RBI said that's every bank, please pay attention, every bank will decide its minimum lending rate. Every bank will decide its minimum lending rate, and the bank will not be allowed to provide loan below this lending rate. So if someone asks you what is base rate, you will say minimum lending rate below which bank can't lend, and this lending rate will be decided on the basis of parameters given by RBI. And RBI gave 4 parameters. What were those 4 parameters? The first parameter was cost of funds. Cost of fund means bank is providing loan, but that amount which is given on loan, it does not belong to bank. Bank has borrowed it from the public. So bank will be paying interest on it. So this is the cost of fund for the bank, the interest which bank is going to pay against its deposits. Then we have unallocated cost of resources. I hope you have heard about CRR, cash reserve ratio. This is the ratio which bank will maintain with itself in the form of cash, and bank will get no return. So this was also included. So we can say that negative carry on CRR is taken into consideration. And the last one is return on net worth, or we can say that return on net worth. We can also say that in easy terms, profit. So this was the base rate. This was introduced. It was fabulous. Now, if I am a customer, I want to borrow a loan. Before going to a bank, I would check the bank's website and check the base rate. The bank with lowest base rate will attract the maximum customer, and bank will decide its base rate on the basis of these factors. So it will be transparent that why bank has decided the base rate to be this value. Fine. Now, over the period of time, what happened? RBI has changed its repo rate. RBI has changed its reverse repo rate. RBI has changed the bank rate. But the impact of repo rate and reverse repo rate was minimum on base rate, which means on one side, RBI is increasing the repo rate so that money supply in the market decreases, so that inflation in the market decreases. But even if RBI is increasing its repo rate, the bank's lending rate is not changing, because the bank's lending rate is decided through base rate, and in the calculation of base rate, RBI parameters are not included. So when RBI realized that repo rate cannot be used as a perfect measure to control the inflation rates, so RBI replaced base rate with MCLR. Not only this was the reason, repo rate wala, There is one more reason which I will be discussing with you in some time. So after this, RBI came up with a new method, and the new method is known as marginal cost of fund-based lending rate. Marginal cost of fund-based lending rates. Now the question over here is, now the question is, so what is MCLR? It says marginal cost of fund-based lending rate, which means that along with negative carry on CRR, along with using the marginal cost of funds, in which we will not only include the cost of funds, we will also include the marginal cost of funds. Marginal cost of fund means if bank is borrowing the funds from RBI on rates like repo rate and all, they should also be included. For your understanding, you can say that along with bank's rate of interest, repo rate wala factor has also been added. One more point for which this initiative was taken was what? Pay attention. Sir, in case of base rate, minimum lending rate was decided, let's say it is 7%, and it is same for everyone. The moment two customers enter into the bank, A and B, now A is an industrialist, he has a good credit ratio, he has a good credibility in the market, he is ready to pay all the required securities and whatnot. And second one, B is, I would say, he's a daily wage earner. He has not paid his ITR in the past, he do not possess PAN card, but still he is looking for a loan. Now in this case, we can say that this is the prime customer and we can say that this is the subprime customer. Obviously, when loan will be given, lending to A will be done at a lower rate of interest, but obviously above 7%. But in comparison to A, the lending rate of B will be high. It's quite obvious because it's subprime lending. But the problem is, the moment you are entering the bank, without taking into the consideration of the factors like credibility of the customer, tenor of the loan, that is time period of the loan, and other factors, the minimum base rate or the minimum rate cannot be same for everyone. So that is the reason tenor premium was added, and the tenor premium says that, let's say the rate of interest is 7% plus minus 0.5%. It cannot be greater than 0.5. So this is the range given, which means the minimum lending rate can be as low as 6.5. It can be as high as 7.5 depending upon the loan tenor. So this tenor premium wala part was newly introduced in the case of MCLR, marginal cost of fund-based lending rates. Things were going good. Remember that this is 0.5%. This is known as spread, and it cannot be greater than 0.5%. This is the maximum limit. It can be 0.1 to 0.5, or I would say it can be greater than, I'll write in this manner, spread can be greater than 0 and less than 0.5%. That is a point. Now, MCLR was introduced. Up to an extent, repo rate wala problem was solved, but 100% it was not solved. Still, RBI was not convinced, and due to the same reason that repo rate was changing, but its impact on the bank's lending rate was not in a same manner or not in a same reflection the way they are increasing the repo rate, RBI removed or RBI replaced MCLR with a new method, and that new method is termed as EBLR. The new method is termed as EBLR, which means external benchmark lending rate. External benchmark lending rate was introduced on 1st October 2019, where RBI came up with a very simple form. RBI said, we give you 4 rates, you choose any one, and you set your lending rate with respect to that rate. For example, we are giving you repo rate, we are giving you 91-day treasury bill rate, whatever the rate of interest is offered by government or on the T91 bills. Same for 182 bills as well as any other benchmark market interest rate which is developed by Financial Benchmark India Private Limited. Now, as a bank, let's suppose you choose repo rate. Let's say the current, I'm taking an example, let's say the current repo rate is 6% per annum. Now, as a bank, I would choose my lending rate and I would say my minimum lending rate below which I will not lend is going to be 9%, where 6% is the repo rate, and 3% is the fixed factor which I am adding, and this fixed factor which I am adding, it includes my profit rate, it includes my operation cost, it includes everything. Now, if RBI increases repo rate to 7%, automatically bank's lending rate will increase to 10% because repo rate has increased. Obviously, this will increase by 1%. If RBI decrease the repo rate by 5%, this will also decrease to what? It will decrease to 8%. And this was the reason, or this was the ultimate aim of RBI with respect to the lending rate. That is the reason RBI came up with EBLR, where RBI said, now if we will be changing the repo rate, it will have a direct impact on the bank's lending rate. You must have heard or you must have read in many of the newspapers that banks, they are offering home loan linked to repo rate. Home loan linked to repo rate means, that means my home loan is linked to repo rate. If repo rate will change, my home loan will change. Now, RBI can easily control the inflation rate by changing the repo rate. If RBI increases the repo rate, lending rate increase, demand for the loan decreases, money supply in the market decreases, inflation rates will start falling down. If RBI decreases the repo rate, then lending rates will decrease, demand for loan will increase, money supply in the market will increase, and inflation rates will start increasing. That is what monetary policy is, and that can be easily done with the help of the new method, that is EBLR, external benchmark lending rate. So that is the entire story, why it was introduced, which I have already narrated to you. You can go through with it from the PDF itself. So as I discussed earlier, we have a batch, Lakshya batch, for all those candidates who want to be an RBI officer in 2025. Do not forget, if you are still thinking, don't think much, because you are investing less than 700 rupees a month, where you will be getting a job of 1 lakh per month. So ROI is going to be pretty high if you are going to subscribe to this particular course. So I think if you are preparing for RBI, you understand the ROI very clearly, which says 700 per month for 1 year results in 1 lakh per month job for next bare minimum 35 years if you are 25 years of age. So this is a win-win situation. Don't forget, do subscribe to it, do join our classes, and I will be catching you all today at 9 p.m. on Testbook application in a masterclass, where I will be discussing what is credit rating, what is credit score, which I have, these terms have been used by me rigorously in this session, but in 9 p.m. session on our Testbook application in a masterclass, I will be discussing in detail what is credit rating, what is credit score, who is responsible to calculate the credit score, what is CIBIL score, what is CRISIL, and many more. If you want this PDF, you can join my Telegram channel, scan the code. My handle is @Madhav Arora, or the name of my channel is Economics by Madhav Arora. Thank you so much. Good luck. God bless you all. We'll catch you today at 9 p.m. on the application. Thank you.